Welcome to the Phoenix Prosperity Podcast, where wealth meets legacy. Join your host, Tim Fergestad, as we explore the journeys of Phoenix's finest to success and beyond.
Hello, this is Tim Fergestad. Thank you for joining us. I'm very pleased to have Austin Peterson with me here today. Austin is a comprehensive financial planner out of Scottsdale, Arizona. Austin began his career in financial services in 2000 as a personal financial advisor and then joined Pacific Life Insurance Company as an internal wholesaler for their variable annuity and mutual fund products. Then formed his own financial planning company and ran that for 6 years and eventually sold when he moved to Salt Lake City to pursue his MBA. Following that, Austin worked in the life insurance industry some more and then joined former broker-dealer Lincoln Financial Advisors in February 2015. This is a lot because it's awesome. Austin is a certified financial planner and a professional and chartered life underwriter. In 2021, he received 2 additional designations as a certified business exit consultant to help entrepreneurs plan to exit their businesses and certified plan fiduciary advisor to develop and implement comprehensive retirement plans. That same year, he merged his practice and founded Backbone Planning Partners in an effort to better serve their clients and his clients. We partnered with, who was it?
Land and Mance,
and have an even greater focus on small business planning. All right. Thank you. Welcome to the show, Austin.
Yeah, you bet. Thank you.
And that sort of matches up with a lot of your designations there on your name, your title on the screen.
Yeah, they're all there, man. It's like alphabet soup after my name.
Yep. So can I ask what you're most proud of out of those?
Gosh, the MBA was a lot of work. So 2 years spending the evenings away from my family to be able to get that done was a lot of work. So I would probably say that. But in terms of designations, the certified financial planner designation is it's the top of the top in financial planning. It's the same as getting a master's degree in financial planning. I know many attorneys who have taken the exam for the CFP and also taken the bar, and they've told me that the CFP exam is more difficult than passing the bar. So I'd probably say that one's at the top.
I believe that there's the chartered financial consultant versus the certified financial planner that has, a fair number of courses as well, right?
Yep. Yeah, I would say that's probably A1, right?
Okay. So do you want to just back us up and run through sort of why you got all those and the sort of the nature of that journey? Was pretty organic, I imagine.
Yeah. I think for me, the certified financial planner professional designation, the CFP, is if you're going to do financial planning, you really should have that designation. And the reality is a lot of people that do what I do for a living that are just investment advisors call themselves financial planners when they're not really doing planning. They're just advising on investments.
Okay.
And so for me, it's really about the planning first. We always start with planning first. And so if I'm going to be a planner and hold myself out to be a planner, I might as well have the designation that kind of backs that up.
Sure.
So I got the CLU first because it was something that I could get along the way to the CFP. So some of the courses will cross over and you can use them for credit on both. And so that, because life insurance ends up being kind of the cornerstone or a foundation for a lot of people's financial plans. That's where that one came from. And then, we focus solely on business owners. So it's not that we don't have clients that aren't business owners, because when you start out, you take any client who's willing to kind of work with you. But the last 5-6 years, we haven't taken on any clients that weren't business owners. And that's where the CBEC and the CPFA came from, is because, our biggest focus as a practice is actually helping business owners to grow and exit their largest asset, right? The reality is most business owners don't have much net worth outside of their business. And so we're helping them to manage and grow their largest asset, treat it like an investment, and get ready to actually monetize that asset at some point. And most investment advisors, financial planner, whatever term they're using, they don't do that. They essentially ask a business owner, how much is your business worth? they write that down and include that as part of their overall net worth, not digging in any further, not really seeing if it's actually worth that. They're just taking what the business owner is saying it's worth,
right,
and what the business owner thinks they're going to be able to sell it for. But statistics are not in their favor in terms of selling the business, and most business owners really don't have any clue what their business is worth.
Okay. Can you give us a sort of a range in terms of business size or revenue that you deal with or see?
Yeah, a typical client for us is 5 million or more in revenue. We tend to play most in that 5 to 50 million range. Average is probably about 15, 16 million in revenue. And the reason we say that is we're not inexpensive, right? If most investment advisors are making money by managing investments, and we do that as well. So we certainly do make a good amount of money from that. But if you're helping a business owner that doesn't have investments outside of their business to manage, or very little,
right?
How do you monetize that relationship? And so we charge a fee for that planning process. And so because of that, it's not inexpensive. Companies should have about 5 million or more in revenue and at least 10 employees to have enough complexity and have the cash flow to be able to afford the services that we provide.
Okay. If you don't mind, let's sort of, for the listeners and viewers, lay out sort of the different compensation structures for different types of financial planners. All right. There's commission, there's assets under management, there's fee for service.
Yeah. I mean, you just named probably the biggest three, but assets under management is the most prevalent today for sure. And that's really where you're just charging a percentage of the assets that you manage. And typically you're going to look at that about as a 1% fee, right? So if you're investing $1 million with an investment advisor, they're typically going to be charging that account about $10,000 per year to manage that. So that's number one. Commissions it still is out there. It's becoming less and less prevalent, but there are plenty of advisors out there that are selling commission products.
Right.
And they're getting kind of a bad name, to be honest with you, because they don't see that they don't feel like you can be a true fiduciary and act in the client's best interest if you're selling a commissioned product. Because the question then becomes, are you doing what's best for the client, or are you doing what's best for you? And are you using the product that, pays the highest commission? Now, with that being said, life insurance, for example, almost all of them are commission based. There are some fee-based life insurance policies. They're just few and far between, and probably doesn't give you enough to look at to really provide the best product to your client. So, we consider ourselves fee-based financial advisors because we do some commission sales with life insurance. If we could get around doing it, we would, but because the life insurance policies pay that commission, we say that we're fee-based rather than fee only.
Okay. Thank you for clarifying that.
Yeah.
There are some people who also there's different levels of conflict of interest, right? It gets a little funny that some people don't like the fact for assets under management that the advisor can be paid even if you lost money, they still got paid. Right? It seems like a conflict of interest if there's a bad year or two or something in the markets or something. Whereas if it's profit only, then there might be a conflict that they may be a little more aggressive than they should be. Right?
Yeah. I mean, I see the point, right? And the reality is, yes, there is still a fee charged on an account when the market goes the opposite direction, or their specific accounts go the opposite direction. But the fee is minimized, right? So if it's going down, I'm also taking a cut in the amount of money that I managed that particular year. And I am still putting in the work and doing what I need to do from a rebalancing perspective, from looking at, changes in the portfolio. I'm still putting in the management work. We don't have crystal balls, right? We don't have complete control over what the markets overall do. We don't have control over, wars in Ukraine and Russia and Israel and all those types of things that happen that can cause markets to fluctuate or go a different direction. Right. So I see that, but the reality is the negative years plus the positive years may come to an average that we're actually seeking, right? So we tell our clients, look, it's going to go up and down. There's going to be a different rate of return every single year. But based on the portfolio makeup that we have for you, based on your risk tolerance, your time horizon, we're expecting a rate about this over a 10-year period.
Right.
So sometimes I'm going to way outperform what I tell you I'm going to do. And sometimes I'm going to underperform what we're seeking. But over a 10-year period, we feel very confident that we're going to be able to provide that average annual rate of return that we're expecting.
Right. Okay. Excellent answer. And that's kind of the nature of why people need a financial advisor, because there's going to be those swing years and they really keep you from the lows being really bad lows. I imagine. That's
you're
one of the most
right.
important parts of it.
Yeah, you're absolutely right. Vanguard, everybody knows Vanguard. And before the E-Trades and, all that kind of stuff that came out, Robinhoods, Vanguard was known as the do-it-yourself investor shop, right? Now, that's not the reality of their shop, because they work with a lot of very high net worth individuals, and they have a lot of very high quality financial advisors that work for them, many of whom have CFPs. But they were the do-it-yourselfers. But they put out a study, and they kind of renew it every few years. But the reality is, investors who are not working with an advisor underperform by about 3% to 4% per year compared to an investor that works with an advisor. And it's exactly that. You get emotionally tied to it. And when the market goes down, you do the worst possible thing. And that is, you get scared and you sell at a loss. And then when the market's going well, you want to jump back in, and you're jumping in too late.
Right.
Yeah.
Selling low, buying high, all those.
Yep. Exactly.
I actually, that's interesting numbers. I actually thought it was worse than that. I thought I read somewhere that well, maybe the Vanguard studies is their own person, but in general, it was the amateur investor basically barely broke inflation rates historically when they try to invest by themselves. Was the study I had seen. Anyway, okay,
Yeah.
very, very good stuff, interesting stuff. Okay, thank you for sharing kind of what makes you guys unique. You did mention that that you were with what was the language? It said former joined former broker dealer Lincoln Financial. Is this discussing sort of the nature of the industry and how people are going away from that to RIA space? Can you speak to that a little bit?
Yep. Yeah, there's definitely that aspect for us. So a year and a half ago, we left Lincoln Financial Advisors. So they were our broker dealer as well as our RIA. And so when we left, we formed our own RIA. So we cut out the middleman, so to speak, on that side of the business.
Was that hard?
Yes and no. There was a lot of work going into it. There's a lot of unknowns, right? There's audits that you're subject to, directly, rather than being subject to an audit internally at Lincoln Financial. It's the SEC who's calling you personally and saying, okay, it's time for an audit. And they've actually gotten to the point now where they're auditing about 50% of all new firms within their first 12 months.
Wow.
And we happen to be one of those. So we got audited less than a year in, which was, it was actually a good experience overall, because we saw that we did things the right way. We hired the right people to help us to make sure that we had everything in place. So we have our compliance consultant that, makes sure that everything's being handled appropriately, and prepped me for that. And so, it's so much so that she kind of just said, these are the questions that you should be asked, and these are the types of answers that they're looking for. Obviously, be honest, give your version of that, but this is what they're looking for. And it was almost word for word. She had me so prepared for that. But that's exactly why we did it. We felt like, there's no reason for an additional person in the middle there. We know what we're capable of doing. We know what we need to avoid. We're running a shop that's completely above board. And so why be sharing revenue with an additional group if we don't have to? I did hold on to my broker dealer and still do have that today. So I switched from Lincoln Financial to LPL Financial.
Okay.
Landon dropped the broker dealer side, and I only held on to it because we had a block of clients that we had purchased back in the day that were broker dealer products.
Okay.
And I'm actually in the process right now. It should be done by the end of the year to where I will be done with the broker dealer as well.
Okay.
Here, RRIA. Yeah.
Okay. Unwinding that. Okay. Can you explain to our listeners why that's important? Why you wanted to get away from the broker dealer besides just having the overhead of somebody else, I believe. And I'm asking in the context of a bigger menu you can provide to your clients.
Yeah, that was the big thing that pushed us out, was the ability to offer a greater menu of products, right? Or investment options. Because if you think of the investment world as, if I stretch my hands out, all the way out, that's the full investment world. At Lincoln Financial, it was like this, right? Now, Northwestern Mutual, New York Life, MetLife, Mass Mutual, they may be like this, right? So Lincoln Financial was still better than a lot of places, but it was pretty narrow in terms of what was available.
They have both types of investments, stocks and bonds.
Yeah, yeah, exactly. So, and then even then, you didn't have access to everything that was available, even in terms of exchange traded funds or mutual funds or, whatever, even at Lincoln Financial, but not even counting alternative investments, right? I mean, you could look at the alternative investment menu at Lincoln Financial and it was less than a page long.
Right.
And I mean, I'm sure the statistics, but there's a lot of alternative investments out there that we just didn't have access to. And we knew based on, performance and history that pensions and endowment funds have been investing in alternative investments forever. It provides stability to the portfolio.
Yeah. Not correlated, right?
Yeah. Non-correlated.
Less correlated.
Yep. I mean, a lot of them are completely non-correlated, but definitely less correlated than stocks and bonds. And, back in the day, they would tell you when I first got licensed, it's that stocks and bonds have an inverse relationship with each other. Not in 2024, they didn't.
Right. Yep.
So, yeah, you can't count on one to go up when the other one's going down to provide that stability. So adding alternative investments was a big reason for us leaving.
Okay. Also, I imagine from my little viewpoint is the demand, the appetite is gone up as well. A lot of clients and people are looking for that. And
yeah, I think the ones who dig in a little bit further were definitely asking for it, right? Most investors, I would say still north of 50% of our clients, whatever you think. I mean, that's basically what they tell us, right? And
yeah,
we educate them, we explain to them what we're doing, why we're doing it, why we're adding this particular asset class or whatever, and at what percentage. But most of the time it's, we trust you. We're happy with the way that it's gone for the last 10, 15, 20 years.
Right.
Whatever you think is fine.
Right. You're my guy.
Yeah.
Yep. That's a big part of it, right? I speaking from my own past experience before I started doing my own deals and stuff, I didn't know, and I didn't want to risk, jumping into waters I was unfamiliar with, particularly with, hard-earned money. And my expertise was elsewhere. I should focus on that, right? And stay in my lane type of thing. And if I have good earning potential, I might as well get my money to work as well as possible. I didn't know how to do that. So I lean on professionals, somebody else who knows that's in their wheelhouse. That's the relationship.
Yeah. Well, I wish all doctors and engineers felt the same way about it as you do, but they don't.
Oh, no. I have about a third of my investors are business owners, and about a third of them are physicians, and very different personalities. I don't know if it's their nature or their training, but there's a range of there's a spectrum of physicians. Some of them are, as you said, I trust you. What would you recommend type of thing? And I'm not a financial advisor. This is here I can offer you this type of thing. But some of them are incredibly skeptical, right? It's very tricky. And some of them are just super amazing people, totally outgoing. They'll be summiting Kilimanjaro one week, and then they'll be starting their third company the next week while performing surgery, like the full time. They're off the chart, productive. It's great. They want to control everything, and sometimes that's good, sometimes that's bad.
Yeah. Well, they're typically very smart individuals, right? Mm-hmm. The problem that they have is that they feel like they're smarter than most people in every aspect.
Everything. Yes, exactly.
That's the hard part when you're trying to explain to them, look, I've been doing this for 25 years. I've got the designations, just like you go to a specialist or people come to you as a specialist in your field. You need to treat us the same way.
Right. Great points. So at Backbone Planning Partners, you're spending a lot of time helping clients get their business in exit order, or tell us a little bit about when you come in, at what stage, what's the ideal time to come in versus reality, and then how you help people.
Yeah, I mean, we've run the gamut, right? We've had phone calls. Hey, I'm selling my business, or I've already got an offer for my business to be sold, or I'm getting ready to accept this offer, and I need your help. And of course, we'll do everything that we can to help them plan at that point to minimize taxes or whatever the case may be, right? But the ideal is that they're hiring us 3 to 10 years before they plan to sell their business.
Okay.
And that's just because most businesses are not being run in a fashion that is ready to be sold, right? They're not ready for the due diligence that's involved when it comes time to actually look at selling or buying the business. And so it's, putting a management team in place, making sure that your numbers are correct, thinking about all the different things that you're running through the business as a business expense that isn't really a business expense, or that will at least go away for you when you walk away, and that an outside buyer may not be running those same things through the business. So it affects what the numbers look like in terms of profitability. And the classic one is everybody's trying to avoid paying taxes, right? You want to pay as little as possible. Well, that may not be the best strategy if you're trying to sell the business. You need to be able to show that it's profitable.
Sure.
Profitable business pays taxes, right? So it's a tough balance. You want to minimize taxes as much as you can, but you need to be showing that business is not only profitable, but it's profitable to somebody else and not just you.
Right. And how do you, how long do they have to get that NOI up before a sale generally?
You're going to look at least 3 years of income. Okay. So yeah, you want to be doing that at least 3 years before you sell.
Okay. And interesting question here. Thought on my part, I hope it's interesting question is some of these companies, maybe they're not in their 10, even $5 million revenue yet. If you want to start with them 10 years out type of thing, do you ever offer like a fractional CFO or some sort of equity to get these companies on the right track up front? Is that relationship a possibility?
It's something that we've thought about forever, right? And okay. Honestly, it goes back to what you mentioned earlier. I have to look at it and say, well, what's the conflict of interest on my side if I approach it that way? Right.
I feel like that's an alignment more than a conflict, but you've thought about it longer than I have. I thought about it for 10 seconds here.
Yeah, no, I agree with you. I think, and it is something that we've thought about. We're actually getting ready to launch our own private equity fund as well. And it's possible that we will end up buying one or more of our clients' businesses from them to be owned by this private equity fund, right? And so we'll have to kind of walk that line and make sure we're avoiding all conflicts of interest that we can, and at least disclosing all of the ones that we do have so that everybody knows what's going on. But to answer your question directly, so we do have clients that do less than 5 million in revenue. Mm-hmm. We tell them, look, this is our price. This is what we know we need to do to help you get there. And so it's a big investment. are you comfortable cash flow wise in handling this? Because it wouldn't be a good idea for us to get started and then you realize that you can't afford the payment to us each month, and you have to walk away. And so we do have clients who are willing to make that investment, because the reality is a lot of businesses that are smaller and that may only be doing $1.5 million in revenue, the owner of that business may be taking home $500,000 a year, right? And so if they're willing to reduce what they're taking home to invest back in the business to help then grow it, to then, become a true corporation, if you will, or a business that's transferable, then absolutely we'd be willing to help them. It's just, we've found that most of the time, until you hit that 5 million revenue mark, it's a struggle to realize you're writing a pretty hefty check to us each month.
Okay. Changing gears here a little bit, I have a mix of investment questions, and I'd like to ask you, what's been sort of the best and the worst investments you've come across?
Oh, the best and the worst investments.
Yeah.
Well, I would say that in terms of my client's experience, and this happens to be from a book of business that I purchased, so I didn't sell these investments to the clients.
Okay.
They had some pretty poor performing non-tradable REITs that were in their portfolio that it took a really long time to either be able to unwind, or they sold at a pretty decent loss. So that would probably be the worst. But the best, recently, the best would be crypto funds, to be honest with you.
Bitcoin's over 100K for our listeners. It's December 2024.
Yeah. So, having access to crypto and being able to invest in that has been a great benefit to our clients recently. Overall, it's kind of vanilla, but S&P 500 funds have done extremely well over the years.
They've had a good year this year.
Yeah. Or private investments in real estate. A lot of that kind of stuff can be beneficial. That's another thing, right? Even though it's not technically an exchange traded fund or a mutual fund or something that we truly have control over, we'll work with our clients on real estate investments that they're making privately and explaining to them from a tax standpoint how that's beneficial to them, and different things that they can do there, and incorporating real estate into all of our clients' portfolio in one way, shape, or form.
Right. That's something I've had as a challenge, right? When we work with private equity groups or family offices or something, that's one thing. But when we work with RIAs, historically, it's been a hurdle because they want us to be on a platform. Well, I don't remember, like Orion or some of these other things where they can track it as an investment assets under management when, so that type of thing. And it's usually not worth it for us to bother with all that.
Yeah. It's definitely more difficult, right? Because we've got to be able to provide reporting overall. So I'm sure that's what it was, right? They're looking at it.
That's part of it.
To be on Schwab or Orion or Black Diamond or, something out there to where it can be incorporated into the reporting that we're doing. I did a review meeting right before this, and I'm showing them this is what it's done over the last 12 months. And, these are the changes that we've made. And so I get why they're doing that. There are ways around it. I'm sure you've found some RIAs who are willing to work with you on that and get it figured out. But it just really depends on their investment philosophy, probably the number of clients that they're working with, right? If it's an RIA that's working with hundreds of households, it's harder for them to take a one-off investment that's not reporting on one of their platforms, right? Be able to make sure that it's being overseen appropriately.
Is it easy? So if you're not assets under management, though, if you're fee for service, does that make it easier then? Because it doesn't matter. I imagine it just makes it easier, but.
Yeah, I would say it definitely can. I will tell you, though, that for us, the lion's share of our revenue still comes from assets under management.
Okay.
So we do have fee for service, and it's a much larger percentage of our revenue than most, but the majority of our revenue still comes from assets under management.
Okay. Here's a reflection question for you. Looking back, what do you wish you knew about building wealth or success earlier in your career?
Earlier in my career, I would probably say even just earlier in life, and that's it's not really the investment that matters. It's not really the rate of return that matters. It's the time that matters. Right. I tell people all the time, I think I was talking to, it might have been my daughter, or it might have been one of our younger employees, where I just explained that, when I first got started in this business, I would carry around a card that showed somebody investing in their Roth IRA every year, starting at 18 and having to stop at 30 because they just couldn't afford it anymore with having a family and all that.
Compared to somebody who starts at 30.
Exactly. Versus somebody that starts at 30. And they're shocked to realize that the person that started at 18, stopped at 30, still had more money at retirement than the other one.
Right. That's a great graphic for sure. Okay, excellent. Austin, is there anything else you'd like to add about some of the boons and the services you guys can provide to your clients? I'm sure there's a bunch. I'm sorry to put you on the spot like that.
Yeah, no. I think honestly, the biggest thing that I've been trying to communicate lately is that we're really like this perfect cross between a wealth management practice or a financial planning practice and a business consulting firm, because we really walk both sides of that in helping them on the business as well. And like I kind of mentioned it, but maybe wasn't, as straightforward as I will be now. And that's that you may have a great financial advisor, right? Somebody who's listening to this plan or this program may think, my financial advisor is awesome. He's getting me these returns. He's doing a great job. Great, right? But if he's not helping you on the business and you're a business owner and more than 50% of your net worth, and it's likely more than 90% of your net worth is in your business,
right?
You probably don't have the right financial advisor, right? Because
it's
they
hard to separate those two.
Yeah, they can't help you with the business, or that's not their area of expertise. And both my partner and I grew up in families that were entrepreneurial from the get-go, multiple generations, and we've done nothing but buy, sell, build, acquire separate businesses or shut down businesses. We've done it all over our long careers. I'm older than my business partner, but I've been doing it for 25 years. He's been doing it for about 15. And so, combined, we got about 40 years of experience in a lot of different types of businesses. That's beneficial to a business owner. If you really want to be able to sell your business for the top dollar and reduce your taxes along the way and at the sale, and make sure that your family's taken care of the way that you want to, it's tough to find a firm that does all of those things under one roof. And that's where we differentiate ourselves.
Okay. Excellent point. If people would like to connect with you and learn more, what should they do?
Backboneplanning.com is probably the first place to start. My partner, Landon Mance, and I are both very active on LinkedIn. So you can just, if you search Austin Peterson CFP, you'll find me easily on LinkedIn. Landon Mance is a less common name, so just search Landon Mance on LinkedIn. We're both very active there.
Okay, yeah. Peterson's a Scandinavian name, but not anywhere near as unique as Fergestad. So easier to find me, but yes, and Mance for sure.
Yep.
Okay. All right. Well, thank you everybody for listening and watching. Thank you, Austin Peterson, for joining me today. We appreciate you sharing your story and your insights into success and investing and financial business planning. Thank you.
Thanks for having me, Tim.
Inspired by our guests? Visit PhoenixProsperityPodcast.com/guest and join us on the show and share your success story with Tim. The spotlight awaits.